I was at the USA Men's World Cup game last night, so I'm a little slow this morning, but it was an awesome match. The energy is just off the charts at these soccer games, which is great because I wouldn't expect that, but it is the World Cup, I suppose. It was fantastic.
And we're doing pretty well from what I hear.
We were doing well. We lost in the last second of the game yesterday, but it didn't really matter because we'd won the first two, so it was a good time.
Yeah, yeah. It'll be great if the US starts to get good at both soccer and cricket. Like, basically, there are like two sports that the rest of the world plays that the US does not play.
Yeah.
That somehow, if we can get American teams, that would be awesome.
Yeah, didn't America recently beat Canada in hockey as well? So it's just,
Yep.
you get cricket and soccer, and it's global dominance in sports.
Well, it's just weird because I think soccer is the most popular youth sport in the US, and then it just trails off. People pivot to do a different sport, but almost every kid starts in soccer because it's just so easy to pick up and then it just dissipates.
Yeah.
Well, it's interesting to think of like how much how cultural it is to so much of the world, soccer and football,
Yeah.
in a way that it just isn't in the States, right? Sure, it's like low infrastructure, easy sport to pick up and play anywhere, but it's part of the DNA of different countries. My high school, there was a handful of kids in every year group who wanted to be professional soccer players, right? I don't know if that's, and went on to be, semi-pro or, try careers and put all chips on black on soccer. So, I don't know if that's, common in the US or if that's, kind of just in a few other sports and, basketball and American football. But yeah, it's just so much part of the culture of these different countries, right?
Yeah.
Yeah. Yeah. So, Alex, we met because of Jeremiah, who unfortunately couldn't be here today. But I guess I was curious, as you think about how you build Privy, just to like kick us off, how much learnings come from your time like, what are the things you're carrying with you, and why are you carrying those things with you versus the things that you're thinking that you should be doing differently?
It's a great question. So just to spend maybe a minute on the background on Privy. So Privy has been around kind of forever. I think the first, you know, line of code was probably written in 2012, and it didn't evolve to be kind of e-commerce or Shopify focused up until maybe 2016 or 2017. And then Privy, the kind of pop-up tool, just rode the, Shopify wave for a few years and exited for a fantastic price to Attentive in the summer of 2021. And then I got involved because I had known the founder for many years, Ben Javaway, and he essentially called me and said, there's an opportunity to kind of carve this thing out of Attentive. There's new leadership there. They weren't focused on it. And are you interested? Do you know anyone who's interested? He didn't want to see it, frankly, just shut down. And so we kind of got to work, and the product just needed a ton of love. Like everything about the business needed overhauling. And if you just look at the kind of metrics of the business at the time, I mean, it was basically worth $0. And that, coming from a 9-figure acquisition, kind of worthless in less than 2 years, kind of just highlights how fast tech valuations, frankly, just products, can disappear if they're not continually invested in. And so I just think of SaaS as it's a fast running treadmill. And if you stand still for even a few moments, you are incredibly far behind. And that's where kind of Privy found itself. And so a lot of the learnings I kind of took, and having been, let's say, an operator for the past 6 years, an investor for 12, 13 years before that, was just put yourself in a position to be default alive and give yourself time. And it's just going to take much longer than you think it's going to be. But if you combine that with a team that is just like customer obsessed and you have long enough runway, you'll find pockets of success. It's just going to take much longer than you think. But we've found those like pockets of success. We've rebuilt the product. We've hired a lot of amazing folks into the business. But I think what I'm trying to shed from the past was, I think one of the things I'm just so maniacally focused on, and I kind of credit Stu at Revo from this, was like, try to almost think of everything as a product problem. Like if your things are falling apart, whether that's internally or churn or you're not monetizing effectively, just look at it first from a product lens and just be maniacal about improving the product day in, day out. And that has been the biggest lever for turning this thing around over the past, like 12 months. We've gone from like basically not growing to growing 30% while doing so at a very profitable clip. All because once you get a few things right on the product, everything just seems to shift. And we're operating in a brutally competitive market, but there's still enough of a niche that we've carved out because we're not venture backed, because we're not private backed, we're kind of in charge of our own destiny here. And we only measure success like internally. We don't need to look at companies that are growing 300% per year and say, well, we're not keeping up with that company. How do we think about success in our business? So I've just had to shed sort of a lot of priors about um, product, frankly, about product being one piece of it, but everything needs to be working, which is true. But man, if I could invest in one thing, it would just continue to be product.
Was that a similar philosophy that you had when you were at like Tiny and WeCom, or is it different?
It's a little bit different because you could have, we had kind of like different applications in different niches, and they were usually the best product in different niches, but it didn't really matter if the distribution wasn't there, if the market awareness wasn't there, if the leadership wasn't there, because a great enough product in those small niches just wasn't discovered enough, or they were selling kind of vitamins, not painkillers. So we're operating in a market where every single store of a certain size needs retention marketing. They need email marketing. Increasingly, they all need SMS marketing. And we have just found that if we're providing the kind of right tool for that merchant, word of mouth spreads, referrals start coming in, and all of that because of the totality of the product, most of which is digital, but it's not entirely digital. It's like everything you provide to the customer is my definition of the product. But I think just in the past, I've spent too much time in spreadsheets and not enough time with customers or like deeply embedded in the product where paper cuts, in the product I didn't really think about those maybe 6, 7 years ago. I'd think about like, okay, what are the big product launches? But eliminating those friction points, those like paper cuts, improving the polish of the application is almost as important as these huge feature releases that people do quarterly or semi-annually, which I didn't,
Yeah.
don't appreciate until you're maniacal about everything product.
Would it be fair as an outsider, like outside looking in, for me to say, not knowing anything, I would have thought that one of the things that you brought with you from your prior experience is how to think about the value of the business as it exists
Yeah.
today and what needs to happen to increase the enterprise value of it once we take ownership of it, because it looks
Yep.
like, and you tell me what I'm not seeing, it looks like with Tiny, the part that looks similar is you're looking for assets that where they are today are undervalued relative to their potential. And that
Yes.
seems like a skill that is something you brought with you from your
Yeah.
prior time. Okay.
I would say, but a lot of that is just also shaped by like my 10 years, like well before that. So I worked for a company called Lucadia, which is a miniature Berkshire Hathaway. It was this exact same philosophy of how do I find undervalued assets in almost any industry and position myself for success on day zero, either because I know exactly kind of what needs to be done, or I'm coming in at a price where enough things can go wrong that I'm still not underwater. So I'll give you an example of that and I'll come back to Privy. My old firm, we bought the third largest beef processing company in the US called National Beef. A week after it closed, their largest customer sent them an email saying, sorry, we're going elsewhere. That was Walmart. A week after you're spending $1 billion on a company, 30 of your sales are evaporated. You got to just find a way to stay alive, rebuild, make sure that, you don't have a 3-year horizon. Like I think they exited 10 years later, made a stupid amount of money, but just avoiding silly things, stupid things is my number one mantra here. I think the other part that you brought up is absolutely true because Privy over the past 12 months has acquired two businesses, two venture-backed businesses, and those two have raised a total of $100 million. So I basically got, not all of that went to R&D, but I got products with $40, $50 million of R&D in them, pay with them with Privy equity, no cash. And we kind of knew exactly what success would look like with these acquisitions before we did them. One of the acquisitions I paid $0 up front, is generating a lot of cash. It's purely based on performance of the underlying business over some time. And we brought in amazing talent because of that. So we've kind of taken this small business. We now have multiple applications. We're like well past 20 million revenue. We're profitable. And a lot of that is owed to just, frankly, just shying away from a capital structure that penalizes you, whether that's venture, if you're not a venture scaled company, or debt. And I kind of tell myself, I tell folks in our organization all the time where sometimes time is our enemy, sometimes time is our friend. How do we kind of maintain long-term decision making, but maintain that short-term urgency, like week in and way out? And I was lucky that I had enough folks when I stepped into the company that had been at Privy for 4, 5, 6, 7 years that they'd kind of seen their decisions come to roost and not in a great way. And just calling out some of those examples just helps people think a lot more long term than maybe they're used to in other tech companies where we have to hit this quarter, we have to hit this metric to raise the next round. Like that urgency is still important, but it shouldn't be a do or die thing. Like we should allow ourselves to recognize that things take longer and that mistakes will happen and markets will change.
I guess who do you think would benefit from this way of like what's true about the entrepreneur or CEO who
Yeah.
is best suited to this type of business building versus any other type of business building? Like what are the like if I'm a found most of our audience is like other software builders
Yeah.
basically, right? And so like if I'm trying to ask myself like by the way, like this is like for anybody listening, it's like this is like how you know you're a maestro is like you make it sound simple. That's super dangerous. So I would be very cautious because when it sounds easy,
Yeah.
yeah,
I'm not going to give
yeah.
blanket advice at all, especially to like, the venture game, which I was part of that game, but from the investor side of things. And so we did a lot of venture investing back in the day. My first deal, which I wrote like a 10-page memo on like why we shouldn't do it, was this budding real estate company called WeWork. And luckily my CEO basically said, I like the guy. I'm going to throw in $5 million at the Series A. And that worked out just fine. So what do I know about venture to some extent? At least for me, I think like one question to potentially ask oneself, and there's no right or wrong answer here. It's just people have um, different behaviors. But like, where does validation come from? Does validation come from raising money, seeing your name in the outlets, having it be talked about? And does that kind of propel you forward? Is that a motivating force? Which is completely fine if it is, because that is just kind of how you can build your company. And that in itself can be a path to a tremendously successful outcome. And when we look at one of the best fundraisers in the world, Elon Musk, and what he's been able to do with that skill over 2 decades. Um, for me, I try to just find validation internally or with my team. And I've kind of almost had to with Privy because the Privy that we inherited was such a garbage product that there was no external validation. No one was like singing your praises except for you guys have really good support and customer success. We love you, but like fix your product. So there was no external validation that we kind of hang our hat on and say, this is what we're doing it for. Now it's different. But I think for me, it's very much a version of like, well, this is the truest like path that I know, which is I don't want to be beholden to the kindness of strangers for my business to keep running. And I'm the largest shareholder in this business. Like this is, a considerable portion of my nest egg is in this. And for me, I want to keep control of that. I want to make sure that I can kind of go to bed on a Friday and not be panicked about what's going to happen on Monday. It's just a much easier way of living, maybe because I'm older now, maybe because I have kids. But I think there's just recognizing that venture, even though it's so predominant in tech and software, is still the absolute minority of how businesses get funded and how businesses get operate. And so I urge folks to just expand their network beyond tech. And there's a lot of great communities out there, whether it's YPO or Sam's Hampton Group, where you just kind of trade notes about, how people have funded their business, what growth looks like, how you compound and not necessarily grow 300% one year, but just keep growing 20, 30% per year. You'll end up to be a very large company, even though you take a different path there. And so I think we've heard this time and time again. There's many ways to fund your company. Most companies are not venture scale. And we see this in all the companies that got funded in the past few years. If you're not AI, if you're not growing 400% and you raise $100, $300 million, you're just kind of a zombie company, unfortunately, because the tides can shift that quickly when you're no longer the flavor of the month. So it's just dangerous.
Okay, I have a question for both of you now because we've entered into uncharted territory for me, the world of venture. And I feel like, I clearly completely misunderstood what venture is because you brought up, motivations, why raising, being, the reputational benefit of being a good fundraiser.
Yeah.
And then, why on getting, funded or not getting funded, also being based on other people's kindness. And both of those things, I don't know. Like my understanding of venture is that maybe those could be side effects that would be desirable. But if they're the primary reason, like, you're only getting funded out of kindness, and you're only seeking funding for the reputational benefit of being funded. And maybe I'm completely misunderstood this, but that doesn't seem like why the majority of venture funded businesses would get funded, right? Just out of kindness or just out of for the reputational benefit.
No, but it's not. I think there's a difference. When I say the kindness of strangers, it's just the expression where I'm not in charge of my own kind of destiny. But I do think there's an immense amount of, I mean, maybe it's just called like vibe investing, but like a company that wasn't so great, didn't look so great in October could all of a sudden be hot because maybe one of their competitors was funded. Like, I mean, this for sure. Like the sentiment just changes so quickly in both directions. And that's why you kind of see companies who have been building for years and years and years, all of a sudden they can get kind of a vertical takeoff simply because the sentiment and the market changes. It's really, maybe it has something to do with fundamentals, but there's not a lot of fundamentals to hang your head on, especially in like a new market or in a new company. It's just all about what's hot or what's not in the valley at that time.
Yeah, Jack, I would say a few things Alex is touching on that I've seen firsthand and secondhand. Like I'll talk about my own personal experience, and then I'll talk about like friends' experiences. This like how quickly you can get hot or not is almost impossible to describe. It could be literally overnight, not like the fake overnight that we see.
Yeah.
Like like it's there's like a lot of work and then it's an overnight success, but it's just it gets talked about much later. No. It's like truly overnight, because one thing that's underestimated is the rate at which information propagates within the VC community. It is hours. Like as soon as one VC knows something, it is 4 hours before everyone else knows it or thinks
Yeah.
it. And that's like not an exaggeration, because like they're just texting each other, right? Especially the associates at these VC
Totally.
firms. And so that's why that's why this can happen so fast. It like like literally overnight. So I've seen that happen a lot. And you especially see that in domains where like something has just become possible. And then all of a sudden, like someone builds something and then now everybody is chasing it down. So like to use an example from like someone in our community, like the Maltbook guys, right? So
Yeah.
like they are actually like e-com SaaS founders. They built this thing, Maltbook. The speed with which they got inbounded by VCs after it got hot on Twitter, even though it was really just people in the background prompting their agents to write things on this Reddit site, is like that speed. By the way, I'm not discrediting what they built. To be clear, to have anything catch fire is like a hard thing to do, right?
Yeah.
But I'm commenting more on the VC behavior. It's like that the rate at which people wanted to meet them is like something I've never seen, right? And like no one stopped to think about like what is the long-term enterprise value of this thing, right? So
It's a crazy world, but there's also been so much money and so many amazing returns generated in that like I have such respect for it. I have so much respect for especially firms like Thrive, who kind of came out as outsiders, but just kept swinging, like just kept finding themselves in the right companies at the right stage too. Like they were doing every stage. They kind of recognized the importance and the durability of these technology companies. Um,
and Green Oaks.
and Green Oaks. Yeah. There's just a few, like there are so many firms that I respect where they kind of understand the game that they're playing. And it's not just about who's hot or who's not, but it's about, is this momentum actually going to sustain? And if I put $400 million into this business, which might have $10 million of revenue, $20 million of revenue, like just an absurd amount of capital relative to the actual scale of the business today, is that going to have a step function increase in the probability of success and the outcome of that company? Some cases it's absolutely yes. Some cases it's detrimental to put that money on the balance sheet. And certain investors recognize where that money is helpful, whereas some investors just are solving backwards from, well, I have this is my fund size. This is what I need to deploy, and I need these ownership targets. And they kind of just work backwards from that. And there's, I kind of laugh about all the companies that were doing on-demand, valet, on-demand. Like there was a whole bunch of companies in like 2014, 2015, 2016 that raised a stupid amount of money because everyone was looking for the next Uber. And no one really thought about the dynamics that made Uber what it was. And that includes the founder of Uber, who was able to kind of shape the success of that company in part because of the fundraising skills. So I can talk about this stuff all day long and I really respect it and I really like studied it and admire it. But for me, like Privy was a business that, needed so much love. And I've been able to take advantage of acquiring companies for basically next to nothing that have raised 100 million of venture. They've gone through it, but I'm able to take advantage of those situations. And 97% of companies that raise venture just aren't really going to make it to that next level anyways.
I think the other thing, Jack, you asked about, which is like, I think quite interesting, is this question of how much does raising money get driven by like how the founder wishes to operate? Like how much of it is like, do you get validation or can you like use the fundraisers and things like that to to drive fuel for both yourself and for those who you seek to put around you versus other mechanisms of doing those things? And I think the Elon analogy is a good one in this context where like he's able to use that to like he wields it as a weapon ridiculously effectively. Right? Like doing deals at prices that are like outrageous. Like because he's so good at fundraising, he can buy Cursor for 60, but the effective price to him, like the discount he is getting on that because of his ability to raise versus Cursor's ability to get valued in a certain way is like he's getting like a 70% discount essentially,
Mm.
right?
Yeah.
And so it's like a almost unbelievable thing. I will say that it is true for me that I view it. Yeah, I view it as a weapon to use to drive whatever it is that you're trying to do with the business, whether it's to motivate yourself as the founder, to motivate employees to join you, to motivate customers to buy from you. Like you should use, like
Yeah.
not only should you use the fundraising event for that, and use it like
Mhm.
intentionally for that, but you should also use you should use the capital for those types of things, right? So that's like exactly right. But that's why fundraise announcements are often timed so carefully, right?
Yep.
Like they rarely happen after the actual raise, right? It's
Totally.
usually like a year later. So
Yeah. No, it's and it's reflexive, right? So the fundraising allows you to hire more people, which or hire the right people, which increases the odds of success. And so it's not black or white. It's just how do you maintain optionality
yeah,
for various outcomes in a business post that.
I guess on this topic, because there's a lot of like common threads between fundraising and acquisitions here. What were I guess, the the main driving factors in the two acquisitions for Privy, right? Zenlane in particular.
Yeah. There are a lot of investors. Well, put it this way. A partner is on 6 to 15 boards. Their time is split and they are also obviously looking for new investments. It for most of those companies, and this is the venture model, one of those investments, two of those investments is going to drive the outcome of the fund or they drive the outcome for that partner. If they can find a soft landing that allows them to kind of say we exited a business, gets them off the board, it might punt on any sort of return, but it basically closes that chapter of their investment.
Hmm.
That is a wonderful thing to kind of provide to partners and funds. They know this because they also have to wind up funds. They have to distribute. And you can't, you don't want to distribute shares of a private company to 150 LPs just to try to unwind the fund. Like there's just some legal mechanics that are a source of friction. And so what and I stand by this is that you're going to take like you have a few options. One is you could try to ride it out and see what happens. Two, you could obviously just kind of write off the investment, take your zero and move on. Three, you could sell it for equity. And then you could sell it to a company that is growing, that is profitable, like has line of sight to a base case outcome, still has optionality because you never know what a company is going to grow into over time. But we can show you like here's kind of a range of outcomes that you can get to today. And these are all like they're not based on a frothy market or finding that magical strategic buyer. It's just like there's enough activity that goes on in a market that you can comp people to. But we also have this upshot of like, hey, we're just going to keep building and compounding. So yes, you might get half back, but let's say we compound that over 2, 3, 4 years, like that's going to grow to par. It's going to grow well above that. And that is a really interesting pitch to partners. And the challenge is how do you find a company where the investors are aligned or there's a partner who kind of has outsized decision making to make these things happen? Like all these things are good ideas for lots of companies, but you actually can't structurally make them happen because of the composition of the board or the investors, where maybe the seed and series A are like, hey, I'm still sitting on a 20x return here. I'm not going to give that up. And the series C's are like, best case, we're at 10 cents on the dollar here. So you just get this locked dynamic. And I just have conversations all the time with companies about these dynamics, about these companies to see if there's a mutual fit. I'm very forthright about investors and the management team about kind of how we do things. And that just allows me to move forward quickly or not, depending on what the dynamics are.
Yeah, I think this is underappreciated, Alex. It's funny. It's true also when you are raising the capital.
Yep.
Most founders don't understand the impact of knowing the ways in which the partner they are working with, who is actually the person on the board, can enable them to create that optionality in the future, whatever that range of optionality is. Like I tell other friends, I get a lot of people emailing me for help with fundraising. And there are two parts of fundraising. One is like, how do you get the price and the investment that you want? But the other part is how do you get the person that you want? And that person, their job, yes, is to say yes to the investment, but more importantly, needs to enable you to do whatever you want with the company over time. And the
Yeah.
only way that they're going to enable you to do whatever you want with the company over time is a like very nuanced set of things needs to be true about their role in the fund, what say they have, what are their career aspirations, where are they in their career, how is the structure of the carry pool determined, how does the fund think about, like Sequoia, everyone knows that they have a 40% write-off rate on their seed investments, like super public. They're super public about it. And so it's like, okay, if you want to raise money from Sequoia, like, yeah, if you take a seed investment, yeah, you don't have to worry about going to zero. They
Yeah.
kind of like start with the base case of 40% of our investments are going to zero, right?
Sequoia is a funny one because they're also so good at engineering outcomes for their companies.
A lot of funds are. A lot of funds are. Yeah.
Yeah. And I think, but that's also like, that is an underappreciated thing about venture. Certainly, if you're kind of chirping at it from the sidelines of, oh, they raised $200 million, they were last valued at $2 billion, and they sold for 400. It's like, guys, that's still a phenomenal outcome for this business. That business is doing, maybe was doing 25, 30, $40 million of revenue, sold for 10x that, 400 million. Everyone kind of walks away with a decent chunk of change there. No one's losing money, and people say, oh, we sold for 80% less than our last round. Like
Well,
that's
first of all, that sort of thing, their engineering for business is doing 5 million in revenue.
yeah,
So
yeah.
like, let's just be clear that the
Yeah.
level of engineering prowess is very high. So,
I think it's amazing. Like they kind of, it's they kind of need to keep the music going for all of this to kind of continue working out. So
yeah.
I have a ton of respect for it. I think it's an awesome model. It also doesn't exist outside the U.S. Like I think that the fact that this exists and is a huge industry and is a funder of crazy ideas is an amazing thing to celebrate. I wasn't born in the U.S. Came from a more risk averse like culture. Entrepreneurialism just doesn't exist as much as it does in the U.S. And we should celebrate that this even model of funding exists.
Yeah. Yeah. It's astonishing. What when you acquire companies or you talk to founders of companies that you are going to acquire, how do you think about two separate things? One is like, how do you think about the motivations of that founder in that conversation and how to satisfy those motivations? And then second, how do you think about like your relationship with that founder over that founder's career? Right? Like, because the other thing that I think is super underappreciated and can appear like a black box to people who don't participate as much in these dynamics is like that relationship dynamic both during any given transaction and then long term over time can lead to very unusual compounding benefit for both sides.
Yeah. Um, so the first thing is I just try to get a pulse of what the founder is thinking. So a lot of these founders are smart. They've been thinking about it day in, day out. They kind of know, they know what their outcome is going to be for these transactions. None of them are really that delusional. None of them are holding on. In most cases, they want to do right by the investors, but they want to do something different. They want to move on. They want to build something different. They don't want to be kind of tethered to a business that is just not going to be able to raise that next round, which again could be in no fault to the business. It just goes back to kind of what's hot or not and which way is the wind blowing. That that quarter. But the first thing I tell them is that um, if you're not going to get any proceeds, like just based on the pref stack, go to the board, say, I want to help engineer an exit and I want 15% of the proceeds. Get the board, have motivation for actually helping you sell the deal because the investors won't really do it. They may make a couple phone calls, but it's the founder who's really driving that process. It's the founder who's doing the diligence. It's the founder who's making sure that they can actually get to a successful signing. And the best thing the board can do is sign off on that 10 to 20% call it finder's fee. And that allows the founder to actually get another bite of the apple, which is this is going to pay me something. I have no control of what that is, but there's some value that I'm going to get from helping build this business. You can distribute that to employees. You can do whatever you want with it. But that's the first thing I do. And the second thing I do is just make sure that I'm very upfront about, okay, like these folks are probably going to stay with the business. These folks are going to get cut on day zero. Like, help me make sure this is the right list. Help me make sure that those who are impacted, like even if we're not able to offer generous severance, we can offer our time, which is how do we get these folks different jobs? How can we reach out to folks? How do we help them with the softer landing? And just doing right by the team goes such a long way with the founder. Like every founder that I've kind of interacted with, I'm still chatting with them. I'm still getting their ideas. So they feel like they're involved in the business, but they don't want to be on the board. They don't really want to, they're like, okay, I passed the baton. I did my best at this. Let's hope there's some proceeds. I'm already on to my next venture. I'm already doing something different because that's what these founders are. They're not going to sit around. They're not going to get a salary job elsewhere unless it's OpenAI, I suppose, or Anthropic. And it just gives them that freedom to just continue building and exploring. So they're like extraordinarily thankful, and they serve as great references for other founders who I chat with day in and day out.
And do you try to stay involved in their next venture? Like how do you think about what role you want to play in their ongoing career, or
Yeah, I
do you
don't.
view it? No. Okay,
No,
makes
I
sense.
don't.
Okay.
Yeah. I'm not because I'm not. If I was running an angel fund, like maybe, but I have two young kids, um, and running this business. I have no time.
Oh, yeah.
Totally. Yeah, it's interesting because that's like the game, so to speak, of venture, right? And so just given your history, it was a curiosity because if you think about like the best VC deals, like one of my friends who's now a VC, he made this funny observation, which is basically true. He was like, the seed round for Sierra was won in 2014,
Yeah. Yep.
right?
Yep. I'm just like I'm just so far out of that game. Meaning, like, if I'm going to do VC, I'll just try to finagle like an LP investment or something like that. I think there's just so much. Um, Angel investing is so hard unless you are like almost like in the Bay Area, which I'm not. Two, you're doing it for a very long time, so you're able to kind of follow people's trajectories. And three, you kind of need you need some angel investment hits, like bets to hit to keep funding it. Otherwise, you're just writing 25, 50, $75,000 checks and you're just not going to get a return for like 10 to 15 years. Like you have good cash flow, you have wealth, like all the power to you, but most people are not in that situation.
Right, did I hear that right? You said if you're a VC, you would look at you pay attention to funding the VC
Yeah,
as opposed to yeah, huh?
totally.
Interesting. I guess that makes sense. Yeah. One of the things that we've spoken about before quite a lot is the different roles of a CEO versus a founder, right? The entrepreneur and the manager. How do you see that as somebody who has been the CEO of a few organizations that you weren't there on day zero, day one?
I think you have to figure out what the business needs. Meaning, does it need a CEO or does it need a founder? Sometimes you just
What
need
a
a CEO,
great
right? Like sometimes a business, you just kind of need to execute on that plan. Don't stray from it. Like minimize volatility. Sometimes you need to be the founder, and you're like what we're selling is not set in stone. How we sell it, what our name is, what our logo, like none of that is set in stone. And I think you just have to figure out what the business needs. Like Privy didn't need Privy didn't need a CEO. He needed someone to just tear everything apart and say, this is what we're going to go build. It's going to take us 18 months to get there. And our revenue is going to go down every single month while we're building this, by the way. So how do we set ourselves up for success while we're doing that? And the CEO is going to be like, they're just not going to focus on that. They're going to say, okay, well, I need to get this amount of new sales in this quarter to like save the bleeding. Well, like you could do that, but you're missing the bigger picture. And we have found like when I've been on the other side, I have found people who are actually amazing at transitioning from founder to CEO. And that's not an easy transition to make. Because like founder is always a 0-1, but sometimes businesses just need to kind of keep doing what they're doing. Like keep the main thing, not avoid a bunch of distractions, and just keep finding ways to just build enterprise value over time, build your durability over time, build your company over time. And that requires you to like actually be maniacal about process, make sure you're bringing the right people out in, make sure you're bringing the wrong people out as fast as you can, all of which is like proper CEO material, but it's not, I wouldn't say that there's, sometimes they overlap, but they're very different like spirits. Like one is more of an animal spirit. The other one is more of like the kind of benevolent dictator who's running the business. Um, the goal is to kind of minimize volatility. Yeah, I think one of the key things about being a successful CEO, and you see this a lot in public markets, is like they actually kind of want to dampen volatility of the business. And like a great example is this Constellation Software, which just grows, a couple percentage points a year. They never did anything different for 20 years and grew to be one of the largest Canadian success stories of all time. Had that CEO, who has since stepped down, started doing crypto investing and venture and distracted with, maybe he had some successes, maybe he would have pivoted his business, no one would be talking about Constellation Software. No one would give you, it wouldn't be a cult classic like it is today. Because he recognized I'm in a kind of a boring space. I'm buying super niche vertical software businesses. Like we're not going to be doing Super Bowl ads anytime soon. And that's okay because he just found the right kind of business model that works for him. And even though he was the founder of that business, he's kind of acted as a CEO the entire time.
I would say, Jack and Alex, what you are making me think of is oftentimes the founder, it's because of ego that they don't understand the distinction between the role of the founder and the role of the CEO, and the two get conflated. And in fact, it's a very interesting story. But do you know the story of HashiCorp? How they hired in an outside CEO at 2 million of run rate?
Yeah.
Do you know this story? Okay, yeah. So,
but I'm also thinking of Intercom, right? But HashiCorp is a great example too.
yeah. So Mitchell, both of the founders of HashiCorp, neither of them really wanted to do the CEO job. And they recognized in themselves that they had more of that, like, as you described, like the animal spirit versus the, like, hey, we just have to like operate this business. And so they did an outside CEO search unusually early in the company's journey. And then like had to deal with lots of like emotional questions leading up to actually pulling the trigger. Like they had found the person and they had like said, hey, we want to do this. And then like they tell this story actually quite nicely of like how emotionally challenging it was to like actually then make the offer at the very end of that process, because they had to confront a lot of identity, ego, like things like that challenges, which are actually where all the challenges come from. But they knew that the jobs were different. And then once they actually made that decision, then they were able to have that person do that job, and they did the job that they like. And I mean, HashiCorp has done awesome.
Yeah, phenomenal.
Right? So,
yeah, I think it's like that level of deep introspection, both about what the business needs and what you are, and who the person is so critical to just making sure that the business is aligned with that. Because like every business is just an extension of the founder or frankly the CEO. Like it just is what it is. And just any sort of misalignment, whether that's behavioral, temperamental, spiritual, and any sort of misalignment, it's just like rowing a boat. Like one little small thing is going to torpedo the entire boat. And that's something I am a lot more appreciative of, just having seen misalignment in so many companies. And the flip side of that, which is, okay, when alignment actually hits, it's a beautiful, magical thing. And things just feel easier. Like you can actually feel misalignment in a company or in a team, even though you can't pinpoint like, why isn't this working? And leaning into that feeling, I think, is a tremendously beneficial thing that just comes from experience and having seen it and be able to remedy that. Is something I'm just always mindful of.
One of the things that I noticed from some of our conversations, and I guess you can't separate the two, is this conversation of like what it feels like to be in the business, to manage expectations, to get the team on the right track, to get the bad people out, the good people in.
Yeah.
But then also, that's all very different to in service of, but very different to responding to the actual market, right? And what the market's asking for from you. I wonder how many businesses, small startups, software businesses, get lost in that piece, right? And end up spending an inordinate amount of their time on all of the internals, as opposed to how this business is going to shape to meet consumer demands, right? Or whatever demands it is that the business is satisfying.
Well, it's funny. I mean, can I answer a different question, Jack? Do you mind? Which is
Sure.
like, you just made me think of like right when we kind of took over Privy, like revenue is declining every single month. How do you maintain morale in that situation? How do you kind of shield the company while still being transparent? Because some things are going to go right, some things are going to take longer than you think. And how do you build that morale internally when certainly everything from the external, everything is saying like, hey, this product's not working, or your positioning is not working, or whatever it is. Like the market is basically saying no just by looking at the company's revenue. But internally, the company is like jazzed about it. It's a new chapter, but you got to put points on the board to maintain the momentum. So I just had to, and I struggle with this. How do you put points on the board, whether that's celebrating shipping something, a huge renewal, and you kind of have to shield what you share with your employees to kind of maximize the kind of potential of the greater good here. And I think that's hard. I think a lot of CEOs don't find themselves, a lot of founders don't find themselves in that position where maybe they start amazingly transparent, but as soon as something shifts and things are not going the right direction, they lose that transparency. They don't communicate as much with investors, and they actually spend all their time on the internal stuff without focusing on like, okay, well, the market shifted. We need to kind of meet that new market and rally the troops internally and kind of burn the boats about whatever happened in the past. It's like, yes, we kind of hit this like inflection point, but like most things, it just kind of fizzled. And we get to refound our story. And here's the bet I'm taking. Come along for the ride. Even though it's going to be kind of bumpy to get there. Like people enjoy that because that struggle like just makes things more exciting, makes us feel more human.
Yeah.
Mm.
Alex, I don't know, Jack, I don't know. I think I've shared this, but we did the same thing with Vermont last year. Like last April when the tariffs hit, like we had a massive, because it was largely an SMB mid-market focused business for a long time, and it grew super fast. I think at some point, I think like in 24, we were like one of the 10 fastest growing Series A SaaS companies. And we raised like a huge B off of it and all of this sort of stuff. And then like, whether it's causal or correlated, it doesn't matter. When the tariffs were announced, the business hit a wall. So we can talk all day about why and all. It sort of doesn't matter. Like the details don't matter. The truth is the business hit a wall. And we had to literally, I mean, again, you have to do these like tough, real conversations of like, we are no longer that business. We are going to build an enterprise platform. Here's how we're going to build it. Here's what we're going to do. And then you have to get people to like not worry about the things that they feel like are the bad things that are happening to the old business, and like take that anchor off and like let it go, put it behind you, and just focus on building the next thing. And then it wasn't until October, so it took like 6 months before the first like evidence of like, hey, the shift was correct. And then you start building momentum, and then the wins start to compound, and then you can like truly put the old thing behind you. But yeah, it's like it is super painful. It's super
It's
painful. I
like
know why people don't want to do it. I get it.
appreciate it on the other side though. It's like you kind of have to go through that struggle to appreciate it, and it just makes you a more durable company at the end of the day. And maybe it's a funny part is like 6 months is such a short amount of time, but also 6 months ago, like Cloud Code hadn't really exploded into the universe, right? So it's both a short time, and forever in tech world. And I think that goes back to like, when is time your friend? When is time your enemy? Recognizing that, being able to like still think long term, but also like, hey, the world can shift overnight, and we have to burn the boats. We have to your point, like just let go, because we're all still small businesses at the grand scheme of things. Like we can still turn pretty quickly. We don't have $1 billion, a huge partner ecosystem, all these massive teams that prevent us from moving so fast. And that's that's an awesome place to be, candidly, in such a fast moving world.
Absolutely amazing. Yeah.
Good. I had a lot of fun. I don't know what we talked about, but I had a lot of fun.
You know what? I got to admit, yeah, I'm on the same page. A lot of it was over my head, but hey, I'm learning.
Amazing. Alrighty. See you guys.
Thank
Really
you, guys.
appreciate it.
Talk
Thanks,
soon.
everybody.
Bye.
Bye.